think there is truly room for active investment in the market. Passive has had a great run for the last few years, but I think we shouldn't really throw the baby out with the bathwater. There are some exceptional active managers, as there has been through the history of time, starting maybe with Warren Buffett as one of the most famous active investors that there is. And there's pockets of these managers all across the market. The key is, how do you identify them, how do you find them, and then have the courage of your convictions to back them, accepting that perhaps sometimes they will go through tough times, but once you know that and you understand that before you invest, I think that gives you a really good opportunity to invest in active management and let them really do the job that you're employing them to do. We have a very clear philosophy that we only ever want to use an active manager when we think they can justify their fees and deliver outperformance. If we can't see that in an active manager in a sector, we won't use an active manager. So in our active MPS today, we've got two areas where we do actually use a passive manager. Firstly, in our gilt exposure, where we've gone through a passive ETF product, as we can't find an active manager to deliver those returns after fees. And also in our US large cap exposure, where again we have a passive holding in the Fidelity US index product, because we again cannot find a manager that we think can consistently deliver outperformance after fees. And therefore we want to make sure that we save as much of our clients' money as possible and only really use the fee budget that we have where we genuinely see a chance of alpha. We look for a whole host of different characteristics in our managers when we interview them. Firstly, we want to understand their investment philosophy, so that's how they describe the market being as inefficient. Then we want to understand their investment process, so that's how they go about exploiting that inefficiency. What do they do on a day-to-day basis in terms of idea generation, stock screening, portfolio construction, and so on. We also want to think about their team. Who's the key decision makers in this process? Is it an individual? Is it very much a team-based approach? So we can understand the key man risk. But we also think about the price and the cost of those investments to ensure that we see genuine value for money in investing. We go through a whole process to understand each of these different characteristics, and only then, when we're comfortable with that, will we then move to make a decision as to whether to use that product. I think passive has really done a fantastic job over the last few years, particularly in the large cap area of the market, larger companies. But the market does get very, very inefficient as you move down the cap scale. So smaller companies are really, I think, best served by active managers because there is an inefficiency there that you can exploit. I think also in the fixed interest world, as you look into high yield bonds, emerging market debt, again, can be very well exploited by active managers. In the alternative space, physical property cannot be purchased in a passive form, so you have to go down the active route. And also absolute return is another area that is much better served via active managers. So we do think about active versus passive for every decision that we make, but I think certain areas definitely play to the strengths of active management.